Do Fed rate cuts cause mortgage rates to move higher? Well, the Fed just cut their Fed funds rate 25 basis points on September 17th. And at that meeting, they decided to cut rates because they're afraid of the weakening labor market. And boy, I've never seen a more divided Fed. You had several Fed members wanting 0 more cuts this year, while you had many wanting 2 more cuts, and you even had Stephen Moran wanting 125 basis points more of cuts this year. Now, the median is for 2 more 25 basis point rate cuts at the remaining 2 meetings. There's one October 29th and one on December 10th. But this begs the question, are rate cuts a good thing for mortgage rates? Many people just look at what happens after the Fed cuts rates. And after the Fed cut on September 17th, mortgage rates have actually increased a bit. And the same thing happened last year when the Fed cut rates on September 18th of 2024 by 50 basis points, mortgage rates moved higher. And the same thing happened in November and December of last year. However, it's pretty myopic to only look at what happens after the Fed cuts rates, because you have to remember, the markets are forward-looking. That means that they price in what's going to happen before it actually does in many, many cases. Let's look to last year. This chart will show you that mortgage rates moved down by almost 0.75% before the Fed cut 50 basis points on September 18th. They moved in advance. And the other thing is, when the Fed cut September 17th of this year, well, when did we find out they were going to cut? At Jackson Hole on August 22nd. This is when it was telegraphed from Jerome Powell. The 10-year was at 432. The day of the cut, where was 10-year rates? At 407. They already moved down by 25 basis points in advance of the cut. And during that time, mortgage rates moved down by 0.3%. But then you could see how yields have moved higher since. But you can't just look at the market movement. Was there any coincident economic reports that came out that caused rates to move higher? Well, back in 2024, it was blockbuster jobs reports. And this year, the day after the Fed cut, we got a very strong, and I should say a very low, initial jobless claims report, which showed the pace of firings was really muted, and it's somewhat contrary to the reason why the Fed cut rates. And then you had a string of strong economic reports like GDP and durable goods. But notice how yields have started to move down once again. Well, that's because we got a very weak ADP report showing that job growth was negative 3 out of the last 4 months. And there's a lot of historical precedence for why, over time, rate cuts and mortgage rates have been very well correlated. This is a long-term chart going back to about 1960. And while it's not in lockstep, you can see here that the blue line is the Fed funds rate and the green line is 30-year fixed mortgage rates, and they track very closely over time. The bottom line here, team, you can't just look at what happens after the Fed cuts. You have to look at how the market prices it in ahead of time, if it's perceived that it's going to be inflationary by the market, and if there's any coincident economic reports that are causing rates to move higher.